Welcome to TheoTrade. This is Don Kaufman. February 4th, 2022. Doing the weekend update here on a Friday afternoon, 1 hour after the cash close. Goldilocks market conditions, yeah, they just died. We're going to explain that and much more here on this weekend's update. If that's a phrase that you're not familiar with, well, you're about to be familiar with it. It's a phrase that has been around literally for years. Goldilocks market conditions. And again, they are hereby deceased. First and foremost, let's give you a quick market update on the week, which was once again absolutely downright wild. You know, you just cannot state that enough times in a given week. But you know, one of the things that you have to bring up right up front, because I just don't think that most of the major media did this thing justice. But when you start looking at something like Facebook that ultimately loses, 25% of its value, you realize how substantial that market cap is when somebody says like, oh, don't worry, it's only $250 billion. One of the things that I just wanted to point out, and I'm actually going to pull up the market capitalization specifically of Facebook, because now it's a, a 600 and basically $60 billion company. Are you aware now that Facebook is right in the same realm as Nvidia? I mean, you're like, oh, okay, well, that kind of makes sense. Nvidia, okay, now being priced in the same category, if you will, same market capitalization as Facebook. But there's another way to actually look at this, and this is Facebook, it lost a Costco. And if you have no idea what that means, take a look at the market capitalization specifically of Costco. Costco is a $230 billion company. It's like Costco would be non-existent. I actually saw also one other interesting statistic that, I mean, if you looked at 452 of the S&P 500 stocks, 452 of them don't even have a market cap of, roughly the 220 some odd billion dollars that Facebook lost. I mean, the numbers are just absolutely staggering. The reason I'm bringing this up right up front is that Facebook lost to Costco. One of the things that we've been mentioning just incessantly, week in, week out, month after month, is that, we said you'll know when this marketplace really starts to perpetuate serious sell-off, and it has everything to do with what I term the monsters of tech, or mega market capitalization. Mega market caps, it's your Microsoft, obviously your Apple, okay, your Amazon, which today, hey, listen, I know it's up 13.5%. Your Facebook, which all of a sudden just got knocked back into reality. Google, Tesla is right up there. And again, let's not, gloss over Tesla, the fact that it's still just shy of $1 trillion company. And of course, Nvidia. I mean, again, Nvidia now is basically the exact same size as none other than Facebook. The only difference is Nvidia has, substantially higher implied volatility. With that, let's get kind of down to business, because that's just one thing. It just can't be overstated. The next thing is some just wild, downright wild volatility. We're going to look specifically at the S&Ps and some levels in the S&Ps in just a few minutes. But I just wanted to give you a quick feel for a couple of the sectors. One of the things I look at incessantly, of course, is the SPX, the mother of all products. When we take a look at the SPX, for the most part, we did actually finish the week ever so slightly higher. But today, specifically on this Friday, there was wild selling. I mean, downright wild selling into the cash close. It just doesn't do it justice to look at it on the chart. Nevertheless, we were trading, 45.30, and just moments later into the cash close, we were trading roughly 44.85. I mean, what's the difference? 30, 40, 50 S&P handles amongst friends. The only issue is that happened again in the last 30 minutes of trade. It's like no one wanted to go home long over the weekend, and again, that is a little bit of a tell. We're going to get into, again, Goldilocks here momentarily. The other aspect worth noting, if you take a look at the QQQ, and again, before we actually get detailed into this Goldilocks scenario, again, just kind of a quick feel for markets, look at the QQQ and the auto expected moves. So the Qs also finished the week ever so slightly higher. Taking a look at the IWM ever so slightly higher. So across the board, you're looking at this, you're like, I'm bullish, it's a huge win, and not so fast. And we're going to talk expressly about that. And I'm not going to get in here and get all paired up with no place to go, but you're going to see why conditions have effectively changed inside of this marketplace. So without going too much detailed, again, into any sectors, just wanted to show the major indices. Let's talk about the Goldilocks markets. All right. For that, I'm actually going to cruise over to the spiders, and I want to pull up, in this case, a 15-year in the spiders. Okay. And the only reason I'm bringing up a 15-year is Goldilocks. Goldilocks has been around and been with us for a very, very long time. So the Goldilocks kind of phrase and Goldilocks conditions had everything to do, all right, with quantitative easing. So it has everything to do with the Fed, everything to do with quantitative easing. And there was a lot of, well, if you would, Goldilocks discussion coming all the way back into like the 2013 time frame. I mean, really, some of the first times I think I heard about Goldilocks is when the Fed started doing, like, you know, quantitative easing part 2, which was actually called the twist program, where ultimately the Fed was out there kind of tinkering with longer term interest rates. But what is Goldilocks? And Goldilocks has to do with, like, for example, bad data coming out. Bad data comes out and the marketplace loves it. Why did the marketplace love bad data? Because they knew, of course, that the interest rate would be kept incredibly low, that quantitative easing was here to stay. And you hear about this Goldilocks scenario for years. Then you actually heard right here. What did I just circle right there? Well, that was actually in late 2018, where the Fed came out and said, no, we're actually going to start to raise interest rates. And the market, it did not react very well to the idea of raising rates. For those of you that will remember, and again, I don't want to get ahead of myself over here because that's the onset of COVID, but if you take a look, this was some fairly precipitous sell-side activity here because the Fed was on the accelerator to start raising rates. And of course, we had a little nightmare on Christmas Eve where the marketplace sold off. And all of a sudden, literally 1 week, we heard from the Fed we're raising rates. The next week, Goldilocks is back. What does Goldilocks again mean? It means low interest rates forever. It's all going to be okay. Goldilocks just died today, and I'll tell you exactly why. So, you know, there's a lot of times where bad jobs reports would rally markets. And I'm showing you literally, there were some pretty horrifying, you know, numbers that came out even into 2018 when they were trying to raise rates. A couple of bad jobs reports came out. The Fed did a complete about face. The market rallied back up because they're like, low interest rates for the rest of your life. We're just kidding. We're never going to actually raise rates. Okay. So I think that everybody kind of understands the whole Goldilocks scenario is that everything is going to be just right all the time. Rates stay low forever. Okay. Why is that officially dead? Well, what happened today relinquished quite a bit. What happened today is an absolutely spectacular jobs number came out. I mean, the jobs number smoked it. And I'm just going to highlight it for those of you who can actually see it on your screen. So the jobs number comes out, the employment situation, it was 467,000, which, by the way, Goldman Sachs had like an estimate of we were going to lose 260 or 250,000 jobs. Okay. The median estimate was a gain of 150,000, but no, we did 467,000. Okay. The marketplace actually sold off into it. And that's why I say Goldilocks market conditions, they're dead. Good news is now bad for the marketplace. Okay, this is kind of what I've called, if you guys are Seinfeld fans, it's opposite George, Toda on Rye, right? This is completely opposite. So we're going to get data drops now. And if those data drops are good, it ultimately, what does it mean? It means inflation. Okay, if data drops are good, when I say data drops are good, I'm simply talking about economic data. You know, economic data comes out. If it's good, you can actually see a precipitous drop inside of the marketplace. So we're in this quantitative tightening mode already, and it is very, very concerning. We have some other situations, and I wanted to paint this picture very, very effectively because when Goldilocks was on, okay, you had every condition was just right. And that's exactly why they call it Goldilocks. Well, at this point, you have to start to go through the checklist. And the checklist is like, to me, oil is a very, very serious concern, and something I was actually pointing out a little earlier today while I was live on TheoTrade. But let me actually show you oil. And, you know, I don't want to, this is going to be brutal, but I'm going to pull up a max chart on oil. And it's not the most effective thing because it goes all the way back to the 1980s. But, okay, in every, recent tumultuous sell-off, oil has typically been bid. I mean, we can go all the way back, of course, to 99, 2000, the internet boom. Oil was wildly bid as, of course, the Nasdaq began to crash. If you take a look at conditions, all right, ultimately into 2008, oil was bid and dramatically bid even into 2011. Most people don't remember, but 2011 got downright wild. We thought we were going back into the financial crisis at that point. Oil was wildly bid. Once again, in the Goldilocks world, oil, okay, I mean, really, really mellowed out for a substantial period of time. You know what the other irony is? Oil was bid again into 2018 when that heavy sell side activity hit the marketplace. But right now, behold, I'd pay very careful attention to oil. I don't think that oil, okay, is anything more than a contributing factor to ultimately the Goldilocks is now officially deceased in the marketplace. It's a contributing factor, but it is going to weigh on the hearts and minds like traders. I've been around for a long time now. It's 24 years in this business. And when I see oil flying like this, I don't care about the inflationary pressures. Okay. This is going to be an economic pressure. So you have inflation. So the Fed has to do something. Inflation's out of control. Forget about oil, though. Oil, though, is just putting more pressure on the economy. So you got to raise rates. You have oil going up. It's like everything is stacked against you. On top of it, again, rates are on the bid. When I say rates are on the bid, let's actually pull up the TNX. The TNX. So this is the 10-year is the TNX. We're at 1.9%. Again, if you've never really read anything about rates before, people get a little confused here because it says 19.3, but that is 1.93%. Somewhere in here, we get to 2%, and we may actually see 2% this next week. It's going to get downright hostile in that marketplace. Bonds, if bonds tank, it is over, baby. We're going to talk again a little bit more about that when we talk about the volatility box, but bonds, they actually achieve some recent lows here. In fact, you have to start to pull up 3-year charts to kind of see where bonds are. Even more effectively, when you're actually looking at a chart of bonds, make sure that they're adjust for contract changes. Hit apply, hit OK, because you'll see that when you adjust for contract changes, the bonds actually have to get down to 150 to really start to get my heart pumping over there. All right, so Goldilocks, oil. Okay, we got rates on the rise. The jobs number, good news is effectively bad. Good news is so very bad. Again, to remind yourself, it's opposite George. Good is bad. It's just hideous out there. Next on the docket over here, the volatility. A lot of people are going to point out that volatility is pretty chill. And it is chill, and it should be until the S&Ps actually cross through a very threatening level. You have to realize what we've actually seen lately. Okay, we have seen bouts of wild volatility. We've seen bouts of wild volatility. And when those bouts of wild volatility, like the first time that we hit 4,500, the VIX spiked. The second time we hit 4,500, the VIX did less. The third time was the charm here. We came through it. The VIX did what? It spiked. So the marketplace right now has seen, all right, 1, 2, 3 major bouts of volatility. So it's getting used to it. It's settling in. Bottom line is this. You should expect the VIX to be quiet until we come right down here to this 4,200, specifically 4,211. We start crossing through that line on the screen. Things are going to get downright wild in there. So expect that volatility is going to quiet down. Really crazy thing here too. You take a look at the volatility futures. They are in a very, very mild contango. So when I say mild contango, I simply mean like, by the way, forget about the short duration. You got to start looking at like 39-day, which the Marches. The Marches right now we're trading at about 25, 24, then we're at 25.68, 25.88. I mean, the vol skew right now is kind of like, it's almost completely flat. So this, I'm even like a little bit hesitant in calling it a contango because for the most part, the volatility skew is very, very flat at the exact same time. And again, I like to get a good read on volatility. All right. I like to get a good read on it because there's some contrary indications. Like if you look at the VVIX, the volatility index, you know what's interesting about this? The VVIX, even in a marketplace that was rallying towards the end of the week, the VVIX actually bid back up just ever so slightly. So what it's basically saying is, between the volatility futures and the VVIX, it says stay on your game. I mean, I'm just reading into it. Stay on your game because nobody else is backing down right now. They're just expecting more volatility. The last aspect of this is because Goldilocks is effectively deceased at this point, is long wrong. And I hate to use the long is wrong. This is not time for rhyming over here, but you really need to consider downside risks right now. When you look at the marketplace and you try to be as objective as you possibly can here, so you have a lot of forces ultimately against the longs in this marketplace. The marketplace, though, strictly in my opinion, has been incredibly resilient at this point in time. Again, I'll come back to that here in just a moment. So where do we head from here? Because, I'm mentioning long is wrong. Goldilocks is dead. All right. First and foremost, I think we're going back. Okay. We're going back into what I term the volatility box. The first thing that I want to bring up with this idea of the volatility box, and for those of you that have never really heard that terminology, let's look at the Nasdaq futures. I'm going to take the Nasdaq futures. I'm going to snap to a 30-day 1 hour. It's a little bit of an unusual chart, right? But, this is a bit of an unusual marketplace. We had, kind of a quintessential like volatility box forming right in here. Okay, right in here. And whereas here, we're pretty much right on the cusp of the upper edge of the volatility box. So you're like, well, what does that really mean? Okay, I'm going to tell you exactly what it means. First and foremost, all right, we actually had a considerable amount of trade, that generated a huge amount of open interest in the options, specifically right in the neighborhood here between somewhere of about 14,500 and 14,000 inside of the Nasdaq. I mean, this volatility box, though, even though it's here in the Nasdaq, it's the one in the S&Ps that really kind of concerns me. Nevertheless, the point that I am trying to make with this little vol box in here is we head down just very, very slightly. We're going to rocket right down to 14,000. From there, we could start pinging back and forth inside of the vol box. So I really do. I caution you this next week. It's going to get wild in the Nasdaq. Any inkling of sell side activity in the Nasdaq is actually going to drag us and retest 14,000. You got to realize, if you weren't around just a few weeks ago to see this, when we got under 14,000, I'm going to say this as eloquently as I possibly can, all hell broke loose in the marketplace. I mean, it was absolutely hideous under the 14,000. The first time we did it, went to 13,700. Literally, these are our charts. 13,700. A few hours later, we're trading 14,500, only to return the next day to 13,900. You realize we're talking 600-700 point ranges, every, 12 hours in here. The volatility box is an extraordinary and violent one. And I'm pointing it out in the Nasdaq. And normally I don't, spend that much time in the Nasdaq, but the Nasdaq is where it really kind of ensued. Now, with that volatility box there in the Nasdaq, it's also very appropriate to point out the Nasdaq, if it does take off to the downside, hit ultimately that 14,000, it's going to drag the S&Ps right back into it as well. And the S&Ps are actually performing a little bit better right now, and they're performing better simply because products like the financials have been bid up. Products like the energy sector have bid up, much to my dismay. So how are you going to know? This is actually going to be pretty simple. The upper edge of the volatility box inside of the S&Ps is somewhere right in this 4,450, 4,400 level. We're only a hop, skip, and a jump north of it. I actually fully anticipate, though, both the S&Ps, and the Nasdaq to drop back into that vol box, and we're going to, be off to the races a little bit. Next here with the volatility box, I would be very cautious inside of the bond market. So I was just mentioning this a moment ago, but the bonds actually crested into new recent lows. Now, as I said to you, if you contract adjusted this, the bonds have to get all the way down to the 150 level. The bonds, again, have to get all the way to the 150 level to really pave any new turf. So if you look at a 3-year chart, on bonds, you're doing yourself a huge disservice. You must come into the futures contract, adjust for contract changes to make it a continuous chart, hit apply, hit OK. The reason is you'll find out real quick that 150 is actually the marker specifically to the bond product. 150. But here's the bottom line with the bonds: any further sell side activity, is going to cause fear and loathing. Interest rates at that point are going to 2% on the 10-year, and we'll be off to the races. It's really going to start to punish the Nasdaq. Okay, the next aspect with this volatility box, I just wanted to point out, because there's a lot of people talking about, is this a bear marketplace? There's a great way to actually kind of justify that. And you can start actually throwing on like different trend lines here. Let me just show you something interesting here. So if you throw on a trend line, okay, you can kind of measure with these trend lines percentage moves, just recent percentage moves. And you can see the bonds pretty much just from like the beginning of December to present time. Okay, the bonds are off big. I mean, they're almost like 7%, right? But let's actually switch up let's switch up some symbols here for just a moment and make a quick point. If you take a look at something like the spiders, and I say, where's the bear? Okay, where is the bear? Anytime that we're discussing, okay, a move into like, a true bearish marketplace, you got to actually measure at a trend line from high, okay, ultimately to kind of where we presently are. S&Ps right now are only off by about 7%. We're barely even in like, we were in corrective territory, just about 2 weeks ago, but we're barely anywhere there. Taking a look at the QQQ, taking a look at the Nasdaq's a bit of a different story. Why? Well, the Nasdaq did have a high. And you know what? I'm just going to measure it from almost the same spot here. But the Nasdaq, where is it presently? It's down about 13%. But the Nasdaq was actually facing very close just a few weeks ago to bear market territory. The point with the Nasdaq that needs to be taken, okay, is that the QQQ getting back down to the 14,000 level on the Nasdaq specifically is actually very close to entering bear market turf. Last but not least, let's actually go look at the IWM, because this is pivotal. All right, any marketplace, this is actually a recent high here. Okay, in that particular recent high, let's go again, apply a trend line from that recent high to present time. You actually have the IWM that is already effectively crested into true bear market territory. It's slightly out of it right now. Okay, I think it's pivotal to understand that we actually are on the cusp of even discussing like bear markets. Okay, and yet I think a lot of people, they haven't really woken up to this idea. I mean, look, the S&Ps are higher this week. The Nasdaq is higher this week, but you start to look at advanced decline line. The number of stocks that are actually in definitive bear market territory is pretty phenomenal. The entire marketplace at this point is being held together by a handful of products. I mean, it's still like, listen, we talked about the breakdown of mega market capitalization, right? Facebook was the first to go. You still have Apple there, okay? Microsoft, I actually threw on just a short-term short position on Microsoft today. Amazon obviously ripping back, but Amazon's been outright punished recently. So say what you will, talk about like bear market territory over here. I think you can kind of appreciate this, but just recently, I mean, Amazon was off by the tune of basically 25% for just the recent highs was off 25%. It's still down 15%, even after today's, rip your face off rally, 13% rally, and it's still down quite substantially. So again, I think you have to, recognize at this point, and then there were a handful of stocks. That's it. Okay. We have Microsoft, we have Apple. Okay. You can see, you throw Amazon into that ring over there. Now we got Google. Okay. Tesla. I'm not even sure, like Tesla. Yeah, it's hanging in there pretty tough. Nvidia has been getting slammed lately. That's it. I mean, what else do you have to go on in terms of mega market capitalization? So a long portfolio, and I questioned this a little earlier, is long wrong, okay? When you realize what's actually holding the entire S&P 500 together, if your portfolio is dramatically underperforming the S&P 500, completely makes sense. Either you own the spiders and you're down, a few percent, but if you own individual stocks here, this has been a very, very hostile start to the year. Last but definitely not least, as we do each and every week, we update you, of course, on SPX and overall volatility here. Okay, in the week that we just passed through, okay, roughly speaking, we had a $137 expected move. That's higher or lower. We hit, all right, the edge of the expected move, came outside of it briefly, closed inside the edge of the expected move. Again, a very kind of meager gain, on the week, given the fact that the volatility was so high. This coming week, we're looking for plus or minus, you're going to love this, again, $107. So if you're looking for this and you're like, oh, the volatility is kind of dying out, yeah, not by much. Yes, volatility has subsided very, very mildly. Part of the reason vol subsided is we're through most of the monsters of tech earnings. Nevertheless, realize Goldilocks is hereby deceased. So if you get an economic drop that's strong, you can see the market's really, really starting to rock. I'll remind everybody when it comes to premium selling, when I say premium selling, if you're going to sell options in this marketplace, stay away from front month premium selling. Look how low some of the implied volatilities are, like 18% 5 days out. You even go 30 days out. Even like 30 days out, it's only 22%. We're selling back month, okay? We're selling back month premium, 26 vol, the out of the money. Again, the out of the money puts, okay? Skew might not seem, all that phenomenal here, but like those out of the money puts, even 100 days out, you're talking about like 40% implied volatility. So it's huge by huge. Listen, again, another volatile week. And I'm going to tell you right now, this coming week, it too is going to be downright wild. Markets felt extraordinarily heavy throughout the course of this week. I think you're going to see much more of that in the coming week. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.